All right, welcome back. In this next video, I'm going to discuss market timing. So I'll talk about the methods that are commonly used to time the market in individual portfolio management. I'll talk about the value of stop loss and stop buy orders. I'll explain concepts like liquidity warehousing, and then finally I'll discuss a lot of considerations that you should think about when you're trying to time the market. Okay, so why is market timing important? Well, it's because, quite frankly, you want to buy low and sell high, or short high and then buy low. If you could time the market, you would be able to make a tidy profit on those investments or those transactions. Now, I should, before I go any further, say that there is a lot of academic evidence that shows it is practically impossible to regularly time the market, but I will show you a couple of methods that investors commonly use to try and benefit from certain market conditions at certain time periods. So we'll talk about formula plans, stop loss orders, liquidity warehousing, and then timing your sales of different investments. Okay, so we'll start off with formula plans. So what are these things? Well, these are mechanical methods of portfolio management that try to take advantage of price changes that result from cyclical price changes. So these are very, very common amongst a lot of investors who just want to hold certain securities and every so often invest new money into those securities at a certain rate or in certain amounts. So there's a lot of different formula plans out there. There's dollar cost averaging, constant dollar, constant ratio, and then variable ratio plans. So we'll talk about each of these. We'll start with dollar cost averaging. Now, dollar cost averaging, this is essentially a plan where you put a fixed dollar amount in each security at fixed time intervals. So it's like a lot of these, it's very passive. It's a very buy and hold strategy. You are not trying to really time the market. You're just regularly putting in X amount of dollars into each investment. The goal here is to just grow the value in each of your securities, and you typically are going to purchase more shares when the share price is low, and you're going to purchase fewer shares when the share price is high. So let's take a look at an example. So you've got $500 to invest each month, and this is the NAV for the fund that you're considering investing in or you are investing in. So the NAV adjusts every time period. So in January it's $26, February $27, June it was $25 and change. And so what you're doing here is you're investing in however many shares it takes to total $500. So in time periods where the share price of this mutual fund is low, say like August, you're buying more shares, still investing only $500, but then in periods where the share price of this mutual fund is high, like February, you're buying only 18 instead of 20 shares. Ultimately, you're buying more shares when the share price is low, you're buying fewer shares when the share price is high. That's dollar cost averaging. Okay, so over the course of that year, if you're investing $500 a month, you're investing $6,000 total. You've purchased 227, almost 228 shares, and your average cost per share should be lower than in other strategies at $26.32, and your portfolio value should be about $6,800. Okay, the next type of formula plan we have is the constant dollar plan, and this is a plan that divides your portfolio into two parts: speculative and conservative. Your speculative portion, that's where you're putting funds in high-risk assets, say like very, very high-risk biotech stocks. High expected return here. The other portion is your conservative portion. So you're putting in, you might hold a very diverse portfolio of, low-risk stocks. And the goal here is that you're putting in a certain amount, and at certain points, you're going to remove or you're going to add funds to the speculative portion when the value of that speculative portion is somewhat diminished. You're going to skim funds from the conservative portion if that speculative portion or part of your portfolio becomes devalued. So let's take a look at an example of this. So we've got a mutual fund here with a starting value of or starting NAV of $10. So we start off with 10,000 in speculative, 10,000 in conservative. Total portfolio value $20,000. Now, in the first time period, the NAV of your speculative portion goes to $11,000 total. Or sorry, the total value of your speculative portion is $11,000, and the value of your conservative portion is $10,000. That continues next year. So let's say at the end of the second year, you've got 12,000 in your speculative, still 10,000 in your conservative. So what you do is you skim off $2,000 from your speculative into your conservative, and now you've sold X number of shares to get that done. You have fewer shares in your speculative portion of your portfolio, and you've increased the value of your conservative portion. Basically, you've adjusted this so that these funds, these $2,000, are now lower risk. Now, let's say in the next year, the value of the speculative portion of the portfolio falls. It falls to 9,100, and the conservative portion remains the same. Let's say you've got this all in, I don't know, T-bills or something. Well, then you take the $2,000 or a certain amount of money, say like either this year or the following year when your speculative portion is worth 7,900, and you reinvest some of those conservative funds into the speculative portion of the portfolio. So you're basically transferring about $2,000 into the speculative portion. And your end result here should be that whenever the speculative portion is overvalued, you take funds from that speculative portion. Whenever the conservative portion has outperformed the speculative portion, you allocate funds from conservative to speculative. So it's essentially a two-part portfolio where you adjust the weights as needed. Now, there are some other formula plans out there like the constant ratio and the variable ratio plan. So your constant ratio plan, it's like the constant dollar plan. The only difference here is that the ratio between speculative and conservative portions is just going to be fixed. So you just kind of treat that as such. The variable ratio plan, basically you've got the constant ratio plan, except your ratio between these two parts, it fluctuates at specific predetermined levels. So if it goes above like 1,200, you adjust, or above like, in this case, it'd be 55%, you adjust. So you're, again, all of these plans are really just buying low and then selling high. So let's take a look at the constant ratio plan. So similar setup here. You start off with 10,000 in speculative, 10,000 in conservative. By the second year, speculative portion is now 12,000, conservative portion is 10,000. So the ratio here of speculative to conservative is 1.2. At that point, you transfer funds from your speculative into your conservative so that it gets back down to 1. So you're essentially selling shares here. If the value of your, let's say your conservative portion of your portfolio increases relative to the speculative portion, like down here where it's 0.75, then you reallocate funds from conservative into speculative so that you get back to this 1, or this, really it's a 50-50 split, or a ratio of 1. So you're just adjusting the ratio as it gets too high or too low. Okay, now the variable ratio plan, it does something a little different here. You've got the percentage of the speculative portion of your portfolio relative to the total portion of your portfolio. So 10,000 divided by 20,000 gives you this 0.5, or 50%. So what we do with variable ratio plans is we wait for the ratio to get beyond a certain limit, say like 60%, and then we reallocate back down below the initial ratio. So our initial ratio was 50%. Once the value or the percentage of speculative part is above 60% or at 60%, we adjust that by siphoning off funds from our speculative portion into our conservative portion, and we get back down to a certain ratio. We'll say 45%. So we're going below the initial ratio or initial percentage here. Same thing on the downside. So if our percentage of speculative portion goes to like 35%, we reallocate our conservative portfolio part into our speculative part. So we go from 35 back up to 55. So we're just adjusting this in a slightly different way. To be honest with you, these plans are not, the methods for readjusting and reallocating are just not that different. Okay, now, so how can you use limit orders and stop loss orders in your own portfolio? Well, limit orders, these are very often used to identify when you would want to buy or sell. So you can actually create an open limit order for, till the end of the day, till the end of the week, till a certain time period. That way, if the price of an asset falls to the point where you maybe want to buy it, you don't have to keep monitoring that asset. I mean, limit orders are very, very common if you think maybe there's a chance you'd be willing to buy or sell an asset, but you don't think that you're willing to buy or sell right just now. Stop loss orders are also very good. Stop loss orders, what you do is you place them on assets that you own. So I own, let's say, 1,000 shares of, let's say Apple stock. And Apple stock's trading for $150 a share. I might want to put a stop loss on my Apple shares just in case the share price falls below 130 and I'm not paying attention. And the benefit there is that, even if I'm not following Apple stock that day or that week, I'm still going to automatically sell those shares if the share price falls below 130. So the benefit here is pretty obvious. The downside here is that you get what we sometimes call whipsawing, where a stock might fall significantly in a single period and then it bounces back. But because you had these stop loss orders on the stock, you sold your shares automatically, and now the share price bounced back and you lost all of that potential upside. Okay, one other thing that you should consider is that a lot of portfolios will very often have a portion in low risk, very high liquid assets. So think like a sweep vehicle, essentially like a money market fund. There's a reason why a lot of portfolios do this. They hold a portion in liquid assets. One, it prevents or it protects against total loss of the portfolio. So let's say, the entire market got wiped out. Well, you still have some funds in liquid assets that you can allocate to help rebalance your portfolio a little. Also, it keeps, we might say, your powder dry. If you see a really good investment opportunity very quickly, you don't have to liquidate a portion of your portfolio and to make use of that. So we very often, what we'll do is we'll make use of money market accounts or money market vehicles. So if you deposit money in like a Fidelity account, it's automatically put in a money market security. So you're earning interest on those funds. Okay, I do have a couple of final points I should mention here. First off, tax consequences. So taxes are going to drive certain decisions, especially if you're in a really high tax bracket. So you may not want to liquidate your portion of some stocks that have seen very, very high capital gains. So I'll give you a perfect example. I've had United Health Group in my own portfolio since, 2014, 2015. The value of that stock has appreciated by, 250%. If I sell my shares in United Health, that's a 250% capital gain that I'm going to have to pay 15% capital gains tax on. So I may not want to sell my shares in United Health Group because it's in my individual investment portfolio. It's not my retirement account. It's in a portfolio that could lead me subject to tax consequences or capital gains taxes. There is a benefit to, if you have like capital losses, you can actually engage in capital loss harvesting by selling shares that you currently have a capital loss in, and then you can use those losses to offset capital gains. The downside here is that this is only available if you see up to $3,000 in capital losses in a given period. To give you a sense of the capital gains tax rates, here they are for the 2024 tax year. So, if you have, let's say you're a single income individual and you've got less than $47,000 in taxable income, your capital gains tax rate is 0%. So this stuff really isn't going to affect you. If you've got income between 47 and 518,000, you're going to be subject to the 15% cap gains rate, and then over the 512 or 518,000, you're going to be subject to a 20% capital gains tax rate. And there are some other tax brackets or tax types of individuals: MFJ, married filing jointly; MFS, so married filing separately. Maybe a spouse has some student loans, or maybe they're close to divorce. That's when you file this method. And then head of household, you are divorcing or something like that. Okay, another thing to consider: if you are close to achieving your investment goals, and let's say you're very, very close, you may want to reduce the risk of your portfolio. If you're getting really close to paying for a student's college, and let's say that goal is a year away, you may want to reduce the risk of your portfolio by selling the risky assets and investing in some low risk assets as as your portfolio gets right up to that end of your objective. So we very often like to adjust our portfolio as we get closer to these goals. So with that, I'm going to recap. We have several different ways that we try to time the market, or that investors have historically tried to time the market. But I will say most academic evidence indicates that people cannot really accurately time the market. I'd say of all of the investment techniques, probably the dollar cost averaging is the most widely respected one that I showed you today or in this video. Asset sales, they can result in capital gains taxes, so you always want to be mindful of that. And you very often are going to want to sell assets that do not meet your needs. So with that, I'm going to conclude, and I will see you on the next video. Thank you.